Pretty much all new investors I've run into have had one type or another of unhealthy fascination. Many of them are too focused on making a quick buck and think they can day trade their way to a 7-digit account. Many of them fall in love with one specific stock pick and are willing to hold it through hell and high water despite the fact they wouldn't know a good stock if it bit them on the arse. Probably the most dangerous ones are the ones that know about options. And then finally, there's the ones that obsess over dividend yields. Now, if you simply must be obsessed with something, dividends are by far the least bad thing to be obsessed with. Finding out a new investor is obsessed with dividends is like walking in on your son while he's shooting up, and then when you check the vial to see what he's taking, it's just vitamin B7. Like, sure, okay, as long as he doesn't give himself sepsis or an air embolism from not knowing how to use a fucking syringe, the most likely outcome is just that they're gonna have long, luxurious, silky hair. There are worse fates. If you're a new investor and you're obsessing about dividends, that at least means you're not taking heroin. I.e., it means you're not obsessing over daily price fluctuations, you're not going all in on penny stocks, you're not leveraging to the tits with options, and perhaps most importantly, you're not obsessing over some random shit stock tip you got off somebody on the internet. There are a lot of really destructive paths that you can walk, and obsessing over dividends is perhaps the least destructive obsession you could possibly have. Companies that pay dividends are generally profitable, which means investors who chase dividends are less likely to be throwing their money into some ultra-speculative fire pit. Companies that consistently grow their dividends are generally companies which have been consistently growing their profits, which is also a helpful indicator of a quality company. However, obsessing over dividends misses the point. It belies fundamental misunderstandings of important concepts. Concepts that, if understood, would help these people grow as investors. You see, the problem with dividends is that, as a thing taken in isolation, dividends don't matter literally at all. All the good things about dividends I mentioned are just second-order indicators of a thing that actually matters: profitability. Profitability, particularly future profitability, actually matters. And trying to determine future profitability by looking at a company's dividends is like trying to determine the value of a house by counting how many windows it has. Which is to say, sometimes it'll actually work. Buckingham Palace has a fucking lot of windows. But to borrow the advice that my old boss used to give me when I was a programmer fresh out of university, you can't just ask, does it work? You have to ask, can it not work? You can cross the street without looking, and you'll make it to the other side, maybe 100 times. It doesn't make it any less of a bad idea. Because measuring companies by their dividends works sometimes, it is a lot harder to convince people that what they're doing is fundamentally misguided. But in reality, there are a lot of situations where just looking at a dividend yield will get you into a lot of trouble. Now, what I imagine many of you are asking is, what have I got against dividends? Dividends give you money. We like money. So we should like dividends, right? Well, I don't have anything against dividends. I stand by what I said when I said that they literally don't matter. And implied in that statement is that I have nothing negative to say about them either. In a lot of situations, it is more favorable for investors if a company pays a dividend than if they don't pay one. But the decision by a company to pay a dividend and a decision by an investor to buy shares based on a dividend are very different beasts. Very different. Just because dividends are sometimes the right decision by a company doesn't mean that they're a good metric for an investor to evaluate that company. Let me break it all down with an example. Imagine you have a company. Let's call it Cashpile Incorporated. This company does nothing, and is literally just a pile of cash. No revenue, no expenses, no business operations, the board don't take any director's fees, and all the company consists of is a pile of $100 million. With 100 million shares on issue, that makes one share for every dollar they hold in their account. What valuation would you give a share of Cashpile Incorporated? Well, you might be tempted to say $1 each, because that's their underlying asset backing. But its shares can't be exchanged for goods and services. You would have to wait for the cash to be paid out as a dividend, or for the company to be taken over, or something of the sort, before the cash would be accessible. It might take anywhere between 2 months to 2 years for something of that sort to eventuate. Meanwhile, the value of the money inside is eroding due to inflation. Money now is worth more than money later. So depending on the inflation and interest rate situation, I might value a share like this at somewhere between 92 and 96 cents, unless there was a concrete near-term schedule for this capital to be distributed to the shareholders. Now fast forward 6 months, and the special dividend gets announced, and all $100 million is being distributed to the shareholders, a dividend of $1 per share. On the ex-dividend date, what do you think is going to happen to the price of the company? Well, without that cash, the company has no assets and no income and no value. With no reason to continue, it will pretty promptly cease to exist. So on the ex-dividend date, its value will drop to zero, or at least as close to it as the exchange will allow. When you take the cash out of a company, it's worth less, just like how a wallet is worth less after you take the cash out of it. Furthermore, if you came along on the X date, saw that dividend in their history, and used it to calculate a yield based on the share price, which at this point would be the ASX minimum price of 1/10 of 1 cent, then CashPile Incorporated would have a dividend yield of 100,000%. However, if you took that 100,000% dividend yield as a basis to buy some shares, you would effectively just be setting all that money on fire because it's a company with no cash flows or assets of any kind, and unless you manage to sell it to somebody even dumber than you, you will take a 100% loss when it dissolves. Dividend stocks are not juiced up savings accounts. They are not bonds, they are not term deposits. They are companies. When profits fall, dividends get reduced or stop altogether. Stock prices go down. Cash on hand is priced in. Dividends are an illusion. Yield doubly so. Dividends are just a way for companies to return capital to shareholders when they don't have any growth opportunities to invest it in. Unless you're planning to withdraw from your account on a regular basis and are absolutely determined to save a few dollars on brokerage, a buyback would accomplish exactly the same thing. But whether or not a company can afford to pay a dividend, or afford to run a buyback, or afford to invest in future growth for that matter, it is all about profitability. Anytime you see a dividend yield that seems too good to be true, I want you to remember the parable of CashPile Incorporated. You're not buying a dividend. You're buying a company. And if the company stops making money, so will you. Dividends aren't a bad thing. They're also not a good thing. They're just a thing. One of several things that companies can do with their profits, none of which are clearly superior to the others. A good dividend doesn't make a good company, but a good company will make profits, and sometimes the best thing to do with profits is to pay a dividend. If you receive a dividend of $100, you didn't make that money when the company paid it to you. You made that money when a company that you owned made $100 as profit, because you have partial ownership of their cash via your partial ownership of the company. The dividend payment itself is just a formality where they transfer it from their account to yours. A buyback would translate that profit into an increase in your stake in the company, and a quality acquisition would translate that profit into more profits in the future. If a company is printing cash and spends half of that cash to increase your stake in the company, and the only thing you think when you look at it is, well, it's only a 5% dividend yield, then congratulations, you just played yourself. Because as far as your stake in the company is concerned, a buyback is basically just a dividend reinvestment plan. So you just turned down what is effectively a 10% dividend yield because you weren't interested in reading the fine print. It's already hard enough to find good investments. If you're only looking for stocks with dividends, you're going to miss most of the great investments that are out there, because it's very rare for companies to go all in on only the dividend. Most profitable companies will be doing some combination of all four of these things. There is another reason that it's important to understand you already owned the dividend before it was paid out, and that's because this explains the price action you see around ex-dividend dates. I've met so many people who, when they learn about dividends, cook up some nonsensical plan to buy or sell shares before or after the X date to either capture the dividend as profit or to rebuy the shares on the X date for a discount. Neither of these things are going to do you any good, as illustrated in our handy wallet diagram from before. Sure, you can buy a wallet, take the money out and sell it, but taking the money out decreased the value of the wallet. Sure, you can buy a wallet somebody just took the money out of and it'll be cheaper, but that doesn't offer you any advantage because if you just bought the full wallet and took the money out yourself, you could have used that money to buy more empty wallets. No matter what clever bullshit you think you've figured out, I promise you that notwithstanding any random noise on the daily chart, you're going to end up in the same situation with the same returns, whether you buy or sell the day before or the day after or whatever. It doesn't matter. Now, having said all that, it is worth keeping track of dividends when you're valuing a company, because if they've paid out a big dividend recently, the company might have a lot less cash on hand than was described in their last financial report, meaning that you should pay less for their shares as a result. Aside from that, just focus on picking companies that you think are going to make loads of money, because that, more than anything, is what will decide their fate. And that's about it. I have a series with more videos like this targeted at new investors, and I also do a series that follows my portfolio and my investing journey. If that sounds interesting to you, you should go check them out. Later!